A single flower worth more than a mansion. A piece of paper representing a train track selling for a fortune. A website with no profit being valued at billions. Sounds absurd, right? But they're not fairy tales. They're snapshots from some of history's most infamous financial meltdowns. Financial crises have plagued us for centuries. But what if I told you that they're all driven by the same force? That there's one reason behind every financial crisis we've ever experienced. One thread connecting tulip mania to the Wall Street crash of 1929 and even the global financial crisis in 2008? By the end of this video, you'll understand the real cause behind every financial crisis, and it's probably not what you think.
And here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
To understand how deep this goes, we need to start our journey in 1637. The Dutch Golden Age is in full swing. Art, science, and trade are flourishing, and everyone's gone absolutely bonkers over tulips. These colorful flowers aren't just decorations, they're the Bitcoin of the 17th century. Picture yourself in a bustling Amsterdam market in 1637. The air is thick with excitement as traders frantically wave contracts for tulip bulbs. A single Semper Augustus bulb changes hands for a price that could buy a Grand Canal house. People are selling their businesses, land, and life savings to get in on the tulip trade. But here's one thing. Most traders have never seen a physical bulb. They're dealing in futures contracts, essentially betting on flowers that haven't even bloomed yet. And then, just like that, it all comes crashing down. In February 1637, tulip prices collapse virtually overnight. Fortunes evaporate, contracts are left unfulfilled, and the Dutch economy takes a huge hit. But tulip mania wasn't just about flowers. It was the world's first recorded speculative bubble. It showed us how quickly rational people can become irrational when greed takes over, and demonstrated how easily we can convince ourselves that the prices will keep going up forever. Sound familiar? It should, because we've been repeating this pattern for nearly 400 years. Let's leap forward in time. We're leaving behind the wilting tulips of the 17th century Holland and landing squarely in the middle of 19th century America. The air is filled with the sound of steam engines and the clank of iron rails being laid across the continent. America is in the grip of railroad fever. Iron horses are revolutionizing travel and trade, and everyone wants a piece of the action. Banks are throwing money at railroad companies like there's no tomorrow. Farmers are mortgaging generations-old land for a shot at railroad-stocked riches. It's a gold rush without the gold. And just like our Dutch tulip friends, it's all built on the shaky foundation of speculation and easy credit. When reality finally catches up, boom! Panic after panic rocks the nation in 1837, 1873, 1893, and 1907. You see the same thing in 1929. The Roaring Twenties are living up to their name, the stock market is soaring, and it seems like everyone from bellhops to bankers is getting rich overnight. Spoiler alert, they're not. Behind the glitz, there's a game of financial musical chairs going on. Banks are lending money to investors to buy stocks. Those stocks are then used as collateral for more loans to buy more stocks. It's a dizzying upward spiral that can only end one way, with a crash heard around the world. Now let's fast forward to 1995. We're leaving behind the echoes of the Great Depression and landing in the heart of Silicon Valley. The internet has arrived, and with it creating a whole new playing field. Silicon Valley is the epicenter of the dot-com boom. The air is buzzing with possibility, and the streets are lined with nondescript office parks that will soon become the birthplace of tech giants. Inside this building, a small team is about to make history. This is Netscape, and they're launching their IPO. Watch the ticker. Within hours, the stock price more than doubles. By the end of the year, it's up over 500%. But Netscape isn't alone.
CD Now is music your way, with more albums than any other music store, online or off.
RentNet. Find it, see it, rent it.
Live your life on the web to the fullest. Intel's Web Outfitter service. Get it now, free at Intel.com.
Every company with .com in its name is seeing similar surges. Pet supplies, groceries, toys, you name it. There's a .com for it. And they're all going to change the world. Except they don't. CNBC turned stock market coverage into must-see TV. Celebrity analysts became household names. Venture capitalists were throwing millions at any startup with a pulse and a domain name. It was like a gold rush, but instead of panning for gold, people were coding websites. The excess was staggering. Startups with no revenue were spending millions on Super Bowl ads.
It makes it crucial to work with a computer company that has experience helping people do business on the net. Well, we're getting free checks, free ATMs.
Christmas parties featured ice sculptures and caviar. One company even hired Kiss to play at their launch party. Why were people so quick to believe in the promise of these .com companies? The answer lies in a powerful psychological phenomenon, the new era thinking. People believed the internet had changed the rules of business forever. Traditional metrics like profit and revenue no longer mattered. It was all about eyeballs and mind share.
And then there's email.
Email? I heard that's really neat. My cousin has a pen pal in Sweden and they write back and forth and it transmits right away and doesn't cost anything.
Yeah, you can even talk with people all over the world on chat lines.
The belief was reinforced by the media, creating a feedback loop of hype and speculation. CNBC's daily show, Power Lunch, became a must-watch TV for a new breed of day traders. The line between investing and entertainment was blurring. But the thing about bubbles is they always pop. March 2000, reality finally catches up. The bubble bursts. Look at this chart of the NASDAQ Composite Index. Notice how it climbs steadily through the late 90s, then shoots up almost vertically in 1999. By March 2000, it peaks at 5,048.62, more than double of its value from just a year before. But watch what happens next. At its peak, the NASDAQ Composite Index reached 5,048.62 on March 10, 2000, more than double its value just a year before. By October 2002, the NASDAQ had lost 78% of its value. Trillions of dollars in market value gone, poof, just like that. Companies that were worth billions on paper were suddenly worthless. Pets.com went from IPO to liquidation in 268 days, burning through $300 million in the process, and there were several other cautionary tales. But here's the million-dollar question. Why? Why did so many smart people, from Silicon Valley entrepreneurs to Wall Street veterans, get caught up in this mania? The answer, as we'll see, lies not in technology or economics, but in the most complex system of all, the human mind. It's 2007, housing prices are skyrocketing. On Wall Street, banks are creating financial instruments so complex, even they don't understand them. And then, boom, the entire global economy nearly collapses. But why? For years, buying a house had been seen as the safest investment you could make. Real estate always goes up, was the mantra. And for a while, it seemed true. Banks were falling over themselves to give out mortgages. No job? No problem. Bad credit? Who cares? They called them subprime mortgages, a fancy term for risky loans. Just 1 year previously, financial institutions had lent out $600 billion in subprime mortgages, accounting for 23.4% of all mortgages that year. This heat map of the United States shows us the spread of subprime mortgages from 2002 to 2007. See how the colors shift as the percentage of subprime mortgages increases, particularly in states like California and Florida. But here's where it gets crazy. These banks weren't keeping these mortgages. They were packaging them up into complex financial instruments called collateralized debt obligations, or CDOs. The complexity of CDOs played a big role in the crisis, creating a false sense of security. After all, if the smartest minds on Wall Street had created these products, surely they must be safe. But the system was built on a foundation of risky loans to borrowers who couldn't afford them. Imagine a big box of mortgages. Some are good, some are bad. Mix them all together, slice them up, and sell the pieces. Magically, these risky loans were transformed into quote-unquote safe investments.
HomeGold is making available to area homeowners a free mortgage evaluation designed to help you improve your financial situation.
It was financial alchemy. And like all alchemy, it was too good to be true. You might be wondering, how could smart bankers fall for this? Imagine you're a Wall Street executive in 2007. Your bonus depends on how many CDOs you can sell. Your competitors are making millions. The housing market has been rising for years. You have complex mathematical models telling you the risk is minimal. Your computer is showing a simulation of thousands of mortgages bundled together. The model says that even if some fail, the overall package is safe. It's rated AAA, as secure as US government bonds. You're not thinking about the individual homeowners struggling to make payments. You're seeing numbers, probabilities, potential profits. And remember, everyone around you, your colleagues, the rating agencies, even the regulators, they all believe this system works. It's a perfect example of groupthink. When everyone believes something, it becomes harder and harder to question it, even for the smartest minds on Wall Street. But here's the fatal flaw in their thinking. The banks thought they had eliminated risk. They were wrong.
One of the biggest clouds hanging over the economy right now is that a rising number of homeowners quite simply can't pay their mortgages. Foreclosures have hit a record high. Many more borrowers are a month or more behind on their payments, and we saw the effects on Wall Street earlier this week of that.
In 2007, housing prices started to fall. People with adjustable rate mortgages saw their payments skyrocket. Suddenly, millions of Americans couldn't pay their mortgages. Those safe CDOs, they were worthless. Banks that had bet big on them were in trouble, and the trouble was about to become a catastrophe. On September 15th, 2008, the unthinkable happened.
Lehman Brothers is going bankrupt.
Creditors of Lehman Brothers filed more than 16,000 claims before yesterday's deadline.
They may not have had the expertise necessary to understand the material they were receiving.
Lehman Brothers, a 158-year-old pillar of Wall Street, collapsed under the weight of its bad bets. As Lehman fell, it triggered a devastating chain reaction. The global financial system froze. Credit, the lifeblood of the economy, stopped flowing. The stock market plummeted, and millions of people lost their jobs. The Great Recession had begun. But was this disaster really about complex financial instruments or housing bubbles? Or was it about something much more fundamental to human nature? Tulips in the 17th century Holland, railroad stocks in 19th century America, dot-com companies in the 90s, subprime mortgages in the 2000s. What's the common thread? What's the real cause behind every financial crisis? It's us. Human psychology. More specifically, our tendency towards greed, fear, and irrational exuberance. First, there's greed. When we see others getting rich, we want in. It's FOMO on a grand scale. During the dot-com boom, people quit their jobs to day trade. During the housing bubble, everyone became a house flipper. The potential for easy money is intoxicating. Then there's overconfidence. We convince ourselves that we're smarter than everyone else, that we'll know when to get out before the crash. Everything is exacerbated by herd mentality. When everyone around us is investing in something, it's hard to resist. We assume the crowd must know something we don't. Finally, there's panic. When the bubble bursts, fear takes over. Everyone rushes for the exits at once, causing a crash. One of the most powerful forces in financial markets is narrative. We're storytelling creatures, and we're always looking for a compelling story to explain what's happening in the world. These narratives are seductive because they appeal to our desire for certainty in an uncertain world. They offer a simple explanation for complex phenomena, and most dangerously, they promise a shortcut to wealth and success. This cycle from euphoria to panic has played out again and again throughout history. Why? Information spreads faster. Trades can be made in milliseconds. The whole world is connected. You might think that with all our financial regulations and sophisticated risk models, we're immune to these psychological traps, but we're not. If anything, we're more susceptible. Look at the COVID-19 economic crisis. Yeah, it was triggered by a pandemic, but it amplified existing trends and human behaviors, from panic selling to speculative bubbles in tech stocks and cryptocurrencies. The tools change, but human nature remains the same. So, now that we know the real cause behind every financial crisis, what can we do about it? Are we doomed to repeat this cycle forever? The truth is, as long as humans are involved in markets, these psychological factors will always play a role. Education is key. The more we understand about market history and our own psychological biases, the better equipped we are to make rational decisions. Diversification is crucial. Don't put all your eggs in one basket, no matter how promising that basket seems. And perhaps most importantly, we need to be humble. Anyone who claims to have all the answers is probably selling something. Make no mistake, these psychological factors are still at play today. All you have to do is look at the recent GameStop craze, where stock prices skyrocketed from $17 to nearly $350 in just a few weeks.
Skyrocketing about 8,000% over 6 months.
GameStop and the frenzy around it is happening to financial markets.
An idea that they were going to demonstrate that they had more power.
It wasn't company performance driving this surge, that's for sure. Instead, a group of retail investors coordinating on Reddit challenged the Wall Street giants, a modern-day revolution against the financial establishment. But underneath the David versus Goliath narrative, the same psychological factors were at play. Herd mentality as investors piled in, overconfidence in their ability to time the market, and the allure of quick riches. So, can a financial crisis happen again in 2024? Based on everything we've discussed, it's not a question of if, but when. The specifics will be different, but the underlying cause will be the same. But there's a silver lining. By understanding this cycle, we can better prepare ourselves. We can make smarter decisions. And maybe we can learn to ride the waves of market euphoria and panic rather than being swept away by them. So, the next time you hear about a hot new investment opportunity, ask yourself, is this the start of the next big thing or the beginning of the next big bubble?